Welcome to the Invest Like a Boss podcast.
I'm Sam Marks.
And I'm Johnny FD. We're self-made entrepreneurs who invest our own money and use modern technology to invest like a boss.
Join us each week for exclusive interviews with our network of modern investors, business owners, and multimillionaires to discover new ways to invest our hard-earned cash.
Hey everyone, this is Johnny, and welcome to episode 22 of the Invest Like a Boss podcast. Back with Sam Marks, and I'm so excited that this week we have the CEO of Betterment coming on.
Yeah, me too. This is a highly anticipated episode, and I gotta say, robo-investing, that term alone was one of the things that excited us to start this podcast. What is robo-investing?
Yeah, so Jon Stein, the founder and CEO of Betterment, is such an amazing guy with such a crazy story that I hope he gets into, because it's one of those things where I really believe that the terms of Betterment and investing Betterment, these are things that we can discuss after this episode, because obviously he's the founder and CEO of the company, so he's obviously going to have great things to say. So me and you can kind of deep dive into that a little bit more. But I think you can learn so much about someone based on who they are and their story. So I'm really excited for you to ask him those type of questions, even more than like the numbers, because the numbers are pretty transparent. We can just look on the site and see what the fees are and what the possible returns are, things like that.
Yeah, definitely. And I've looked at a bunch of interviews that he's been in. He's very much in the public eye, and I really appreciate that about people in these new, or especially directors in these new fintech companies, to come on and really explain this stuff in layman's terms, express why they started these companies and how they work. And he's everywhere on the web and doing a lot of interviews to tell his story. And I think that's really important, especially for people like us that we're trying to figure out and navigate these new platforms, these new ways of investing. And Jon seems like a very charismatic guy, and he's always willing to tell a story. So we're excited to bring him on the show and talk about it.
Yeah, so let's get him on. Let's kind of figure out, let's find out his personality and his background, how he started, why he started Betterment, and then me and you, we can deep dive in the rest of it on our own time.
Yeah, definitely. And you remember in an episode with Faber, he was talking about how much he liked Betterment, especially in the Robo-Advisory category. And I believe they've recently done a deal together. But we're definitely going to dive into, he seems like a really passionate guy. I'm itching to get a feeling of why they started Betterment and, what his background was before he started Betterment.
So I hope everyone enjoys this episode.
Everybody, welcome back to another episode of Invest Like a Boss. Today we have Jon Stein, a very popular CEO of Betterment, a platform that's pioneering robo-investing, and of course, a listener of favorites. Jon, greetings and welcome to the show.
Thanks for having me. Excited to be here.
And I believe we also have Danielle there, your colleague.
Hi, yes.
Okay, just wanted to make sure we include you. And you guys are in one of our favorite cities of New York, I believe.
You got it. We're on 23rd Street, just near Madison Square Park.
Lovely, really nice. And you've been there for quite a bit of time, haven't you?
Yeah, so we started the company here many moons ago, and this is our third office. Actually, maybe fourth if you count my apartment. But we were in Union Square and Soho, and now up here in what we call the Flatiron.
And were you in New York before Betterment?
Yeah, I've been in New York really since college, more or less. I've been here for, I guess, 13 years now, something like that, 14 years. I lose track.
Yeah.
And I live on the Lower East Side. I love it. I love New York. It's home.
Man, it must be such a cool experience to run such a popular fintech company in New York City. It's pretty incredible.
It's so fun. I feel really lucky. Sometimes people say, things move so fast. I try to really enjoy things as they go. I think enjoying the journey is an important part of my philosophy.
Yeah, definitely. So I imagine that you stay quite busy with all the press and everybody in finance and in tech in New York City trying to speak with you and collaborate and everything else that goes on.
Yes, Danielle and the rest of our comms team keep me pretty busy with with interviews, and I love that stuff. I certainly had never done it before Betterment, but I've come to really enjoy telling the Betterment story, and because I think there's so many interesting things happening in this space, and I want to be sure, because it's complicated stuff. Oftentimes, I want to be sure that we give it appropriate airtime.
Right. Yeah, we love it. I've seen a lot of your interviews, and man, we have so many questions for you. You're really an inspiring guy. Your story is amazing, and so many of our listeners are either running their own business or aspiring. And I think your story, even more so than the platform that you've built, which is incredible, and we all want to learn about how to invest in better, smarter, and more modern ways. But your story is so good that we'd love to hear more about how Betterment got started, your passion, and what drove you into this category to begin with.
Yeah, I mean, I can tell the long version or the short version, but you'll have to cut me off.
No, ramble on. We like to ramble.
Okay. I think the story begins in college for me, really, when I studied economics and a bunch of psychology as well, but majored in economics. And I loved the intersection of those two fields, what we might call behavioral economics today, because it was about how people make decisions and how we can help them make better decisions. And if we could just make better decisions, the world would be a better place. That's what economics taught me. And the idea of efficiency became important to me at that time, and looking for ways to help people be more efficient in their daily lives might lead to more happiness. I got into this, and there's not an obvious career in helping people make better decisions. That's not a thing you can apply to. So I was a little bit lost after college, and I thought about being a doctor. I actually did a post-bac pre-med year, thought about applying to med schools. I love the science of it. I couldn't really get into working in the hospital or working in the biolabs. It's something about it. I didn't like blood. I didn't like that. It was a little too real.
Right.
And I felt like I wanted to do something that scaled better somehow. What I loved about medicine was the idea that you can help people every day. You get a good satisfaction from that. You're working with other smart people, but when I was in the hospital, I wanted to be running the hospital because I saw so many inefficient things, and I just thought this place, it needs help more systematically. And so I decided business was a better career for me. Of course, I didn't know what business meant. That was just kind of like, but both my parents had been city planners, and so I knew a lot about maps and urban design and stuff like that, but not so much business. And I decided to move to New York and look around. And one of my friends was working at a consulting firm, consulting to banks. And he seemed like one of my happiest friends. I mean, he was working and traveling a lot, working hard, but really loving it, getting to meet with senior execs and working on interesting stuff. And so I applied and got a job at First Manhattan. And it was great. I learned so much about the banking industry. We covered all financial services companies. We did things like product development, risk management, investment portfolio policy. And while I was there, I got really into Excel, to be honest. I got really good at building
Excel,
models.
like just numbers and algorithms and calculations.
Exactly. Yeah. And pulling together vast amounts of information and making a simple presentation out of it. So, for instances, we built like a complex mortgage pricing model for a bank, or a deposit product, and all of it would come out into like a simple user interface. And I liked doing that. I liked making simple user interfaces, and I learned to program a little bit. You do a little VBA if you're coordinating across Excel, and because I was doing that. There's kind of a dual track to the story at this point, because part of me, and I'll come back to that, but part of me just wanted to improve on what I was seeing at the banks. In my personal life, I was investing. I found that to be an interesting thing, although over time I grew a little bit tired of managing my investments. I was busy at work. I knew what I should be doing, and yet I was doing some stupid stuff on the side. I was like, of course I had, some good like Vanguard ETFs, and I was managing those. But I kind of famously bought Enron. It was one of my first stock buys, and it went, of course, straight down.
Well, you got to take a couple big risks to balance out the Vanguard ETFs, right?
That's right. So I was investing and learning about banks, and I got my CFA just because I thought that would be a good thing. I decided to go to business school, and I when I went to business school, I knew at that time that I wanted to start a company, and I knew that what I'd seen at the banks, what I'd learned was that they weren't paying a lot of attention to product innovation. They were iterating on the things that they had. Here's a different interest rate on the same deposit account, or here's a mobile check capture, but it's still basically the same account. I wanted to really rethink what financial services could be for people, starting from a customer perspective. And I thought, people don't naturally think, hey, should I open a Roth IRA or a traditional IRA? That's not really the way they're approaching it. They're thinking, I've got to send a couple kids to college, and I've got to retire, and I want to have a steady stream of income and happiness in my life. And how do I kind of manage those things? I thought that I wanted more advice, and people were coming to me for advice, and I thought it's crazy that no product just does this for me, that nothing manages my investments in an intelligent way, and I didn't know exactly what form that would take, but I wanted to work on that and build that thing. And because I had a little bit of the programming skill, I thought, I can build it. I'm just going to go and do it. And I started to teach myself some Flash. I had a roommate who was an engineer at Google at the time while I was in business school, and he was, fortunately, he pointed me in the right direction from an engineering perspective. And I got started just building the first iteration of the website. At that time, thinking I would just do everything myself.
Is this becoming Betterment's first office in your apartment? I love it.
This was back in 2008 or so.
Oh, wow. Okay. So we're going back about 8 years, and I don't want to skip too far ahead, but you were at Techcrunch Disrupt as a finalist in, was it 2010 or something?
You got it.
Okay.
2010, May, we launched. It was the first Techcrunch Disrupt in New York. It felt really well timed because, we didn't have a budget to take the team to California had it been out there. And it was that forcing mechanism that we needed to get the product out the door. We could have iterated and refined it, for another year probably, but we had this deadline, and so everything had to be working on the day that we launched. We went out on that day to 20,000 people watching the live stream, and maybe 2,000 people in the room, and it was the most terrifying and wonderful day of my life up to that point.
Oh, that's awesome. Had you ever spoke in front of such a large group before that?
Never, and I wasn't a natural public speaker. I was. It was really intimidating to me. Now I love it, but I didn't know what I was doing. I memorized my entire speech. I would never do that now. I would just kind of wing it. But I had every word planned, and it was a nerve-wracking experience.
So by the time you got to Techcrunch Disrupt, was the system already managing your personal money?
It was. As I recall it, that February or so, we started putting, and maybe we had tested things earlier, but we really started putting real money on the system early in the year. And those early accounts, back in that at that time, we built everything, right? We built this whole system from scratch, and every penny had to reconcile, and we were moving money and all this stuff, all these integrations. We probably wiped the system a couple of times as we were rebuilding it, but there are records in the system as of February from the team all investing our money. And we continued to then bring on a few family and friends, but we had probably less than 30 customers on the day that we launched. And then we had another 500 customers join us that week. Very
cool. I bet you guys had a lot of fun back in your apartment, coding this up, putting your actual money to work, and then taking it to the public viewing.
It was so thrilling to have people actually coming online. It was, so much work goes into it, and then oh my goodness, it's working. But we were almost, we were so busy. We were actually fielding customer service calls while I was on stage. I mean, the rest of the team was in the audience answering emails and helping people sign up and all this kind of stuff. They were watching, but it was like all hands on deck after that. And we're straight back to the office. And back then we all were answering the customer support calls, and that was the next 2 years of my life was kind of the story of digging out from under that.
Yeah, I think that, one of the things we see kind of across the globe is too many startups today don't do that stuff because they're a little bit spoiled with VC money and everything at an early stage. And there's so much value to be had from answering and running your customer service yourself as the co-founder, because you really see what's happening on an everyday basis, what the feedback is. It's just a constant loop of information you need to make decisions at an early stage. Wouldn't you agree?
I absolutely agree. I think that's an insightful observation and well said. We still have everyone here at the company, and there's over 200 of us now. Mm-hmm. Everyone talks to customers, and we call it Customer Week. We do it, it's a rotating basis. I do it quarterly, and we just, we get on the phones for the week, and we're answering emails and live chats and all the ways our customers talk to us. But it's just one of my favorite things, and I always come out of it thinking, I want to do more of this. It's so important to connect with your customers and to hear firsthand what they are coming to you for, what their problems are, because you get a few months removed from that, and you get too much in your own head. You start thinking about the things that you want or the things that you heard about from somebody else in the company. It's so important to go back to the source, which is the customer.
Very good practice and great advice for everyone out there that's in business and running their own business or aspiring to have their own startup. And John, before you ever started managing your money through the platform, did you ever try using like an actual financial advisor, someone that was a fiduciary or just helping you pick stocks, or was it all done by yourself?
My parents have a financial advisor, and he's a family friend and someone I trust. And he also managed, because he managed my parents' accounts, was willing to manage my money. I don't think I had enough money independently. I'm sure I didn't have enough money independently to get any advice. And I did that for a while. I kind of transitioned away from it, right? I started doing some of my own things, and then I just decided at some point I wanted to do all of my own things because the fees didn't make sense to me. And the way that I wanted my money managed was a little bit different. I wanted things like what Betterment offers. Frankly, I wanted it broadly diversified and tax managed, and I wanted better information about it, and I wanted it based on different goals and so on. But I knew that the incumbent firms, weren't going to build those kinds of tools anytime soon. They're just set up for a very different type of business.
Yeah, I agree totally. I think your story of investing and some of mine, I was also investing very little money in college, and same situation. My parents had an advisor, and they kind of grandfathered in a little bit of money for me. And I always kind of thought, and my parents told me, like, half the value in having an advisor is so that they can help you make smart decisions in emotional markets. And then everyone from my mom, dad, grandma, sister, everyone sold at the bottom in 2007, 2008. When the market was at its absolute worst, when it was probably the advisor's job at that time more than any to help us, make smart decisions, and we didn't make it. And I think after that was really when kind of opened at least my eyes to, you have to take a lot of this stuff into your own hands or find smarter ways to do it. Of course, I was still in college, so I wasn't thinking that as much as an entrepreneur or an innovator. But I think a lot of people, especially listeners, this audience, have lived through that and were probably at an early stage of investing through that and are now all thinking of how to take the emotional side out of investing as much as we can.
Yeah, that narrative resonates with me. I've likewise heard customers say that in a downturn, some customers might maintain an account at Merrill or something like this. And in a downturn, I've heard them say, "Oh yeah, like the broker called me and talked to me about how I should reposition my account for the downturn," which is kind of the opposite of the narrative that you sometimes hear, which is that, oh yeah, the broker is supposed to tell you to stay the course and not
Right.
Panic a downturn. They're calling just to make you trade. I think that narrative of how advisors or brokers help clients is a little bit tired, and it in some ways it doesn't give the advice. It doesn't give advice or advisors enough credit. It to speak about, we hold your hand during rocky markets. our data and our experiences, that's not really what customers need most. Our customers anyway, understand that there's volatility. They understand that, in the long run, things are going to go up and down, but you're going to be better off if you're broadly diversified and so on. What they are looking for is planning and advice around life changes. So it may not be that the market's down, but it may be, I'm getting married and I'm thinking about joint accounts. Like, what's the right way to set this up? Should I think about trust accounts for my kids? There are all kinds of real important life questions, and those are moments when people seek advice, and that's the kind of advice that we provide at Betterment. We tend to automate the information about the markets and give you information in real time that helps you make hopefully the right decision, which is almost always to stay the course during rocky market times.
Great stuff. Good to hear. And what happens after Techcrunch disrupt? You guys are on the phones, signing up a lot of people. I assume that really was a big jump in your guys' business and customer acquisition. What happens over the next few years in terms of Betterment's growth and infrastructure?
So for a couple of years there in the early days, we're really just digging out. We have always ambitious plans for what we want to do with this company. Still to this day, obviously, perhaps more ambitious than ever. And yet, we're at that time 5 people in a room, and there's only so much we can do. So we're kind of treading water and building what we can to automate the back end, so that we can spend more time investing in services for customers and hiring and building a company and all the things that that we want to do. We grew slowly in those early days. It took us, we had $1 million maybe by the end of the first month, $1 million in deposits, which is like, I don't know, at the time, $1 million seemed like a lot of money. And I remember the end of the first year or so, we crossed over $10 million. And wow, we were so happy. We went out to dinner. That was and now that's
hyper growth.
That's like a slow day.
Right.
Right. So things have obviously accelerated a lot. At that time, growing the team was so much of my job, and gosh, we were a family.
Awesome. I think that's also really good advice and good perspective, that when you went from 1 million to 10 million in deposits, it seemed like you had this and by all means it was a fast growing business, but then once you fast forward to where you guys are at today, and then that would be considered a slow day, a lot of people don't understand the scale of globalization and the scale of fintech businesses or any type of internet businesses, and how fast you can go from even let's not say fintech, but an e-commerce store can go from 5 sales a day to 5,000 in a day in a month. And having that perspective that you have is pretty much is invaluable in terms of experience for business.
Yeah, I think we are still just getting started. I mean, I think our current scale is obviously a couple orders of magnitude beyond where we were even 2 or 3 years into the business. But like I said, we're ambitious, and we know that there are many millions of people who want our services, and we've got a long way to go to reach all of them.
So what is your guys' position on active versus passive? I know you have so much data and so much research at your company, and there's always a big argument. A lot of top advisors think that active can beat passive, but we know, at least personally from our own investing experience, every time we touch something, we get hammered. So we just prefer to stay passive. But what does all your data and research indicate?
Yeah, look, I'm not dogmatic about this. I tend to say I don't have a strong view, active, passive, but I'm evidence-based in everything that we do. The company is always evidence-based. And all the data says that for retail investors, for individuals like you and me, after costs, there's really nothing better you can do than invest in a globally diversified index portfolio. There are some new low-cost products, and they're more maybe quasi-active. I think the line between active and passive is being blurred over time as technology takes over more and more of the job of quote active management. And this may be a niche view, but I think of index funds themselves as an outgrowth of that, or sort of an early smart beta product. I mean, to build the first index, which we think of as passive, you had to decide how to construct it, and people decided, well, market cap weighted might be the right way to do it. But that itself is a decision that's encoded and is traded by an algorithm. And you can advance those algorithms, and you can say, well, we want to include price earnings ratios in our algorithm, or we want to include dividend yields in our algorithm. And you can make that more and more sophisticated, or more and more complicated, depending on your point of view. It doesn't, as long as there's good evidence that what you're doing is reasonable and provides good risk-adjusted returns, it could be appropriate for a portfolio.
I like it. And we had Meb and Faber on the show about a month and a half ago, and he was telling us a really funny story that Fidelity did a big research project of all of their customers and all their accounts, and found that the best performing accounts over a 20-year period were accounts that had either been forgotten about or customers that had passed away and thus left them completely untouched. So I think that was pretty good learning for us all.
That's incredible. I heard something similar, I think maybe coming out of Vanguard too. I love those kinds of stories. And Meb is a real intellect. He's always fun to listen to.
Yeah, absolutely agree. What opportunities are there for international investors either now or in the future to use Betterment?
So today you can live abroad, but you have to have a U.S. address and bank account in order to open a Betterment account. So for soldiers living abroad, we open many accounts, things like this. But we can't do it without those things because due to laws and our own internal security processes, we have to verify your identity. We have to know who you are. And it's just not efficient for us to do that if you're not if you don't have a U.S. address and bank account. There's so much opportunity here in the U.S. to grow that we've got our focus on continuing to invest in what U.S. customers need. And U.S. customer needs are not totally unique from others, but they are different. I mean, we have different regulations. We can invest in different things here. We have different cash transfer systems than investors in UK or China or India. Those other markets, we get inquiries every day, in fact, multiple times a day from people there who say, I would love for you to bring Betterment to here, or I am thinking about starting the Betterment of here, and can we part? Every day, multiple times a day. So there's obvious opportunity there, but we tend to take the long view about that opportunity. I think it's not going away. Some would say, oh, you got to get out there and claim territory and get your brand out. I think that's not exactly understanding what we're doing and how transformative it is. It's not just about getting your name out there. We're building an understanding of customer behavior. We're building an understanding of the algorithms that will power the future of financial services to make it more automated, to make it something that you can not have to worry so much about. And those will cross borders over time, and those learnings will help us in other geographies over time. We just need to be patient and invest where our efforts can have the highest return in the short term.
So speaking of worry, I was curious if there's any opportunity. I'm not as familiar with, put it this way, I've never looked at my Betterment account when the market's been bad. When the market's great, it looks awesome. You have all these green lines and green numbers and everything's rosy. But let's say we go into another, a 2008 or something, right? When there's a lot of emotion in the market. I'm sure there's a lot of emotion in the market during Brexit and other events. Do you guys have a plan for how you can, like in the future, even today, how you can help to be a more emotional or psychological advisor and giving people guidance on not to sell, or, referencing historical data that says things should bounce back, or even have someone that you can call to kind of talk through things? Because again, the emotional side of things, and especially with the internet, having things just one or two clicks away from making a trade, it's why my E-Trade account is down probably 10 years in a row.
So I know that feeling. So all of the above. To go back to the story we were talking about, from the beginning, I've been interested in behavior and how we can help people make better decisions in all environments, and particularly down environments where people may be feeling panicked. So the site has lots of behavioral feedback built into it. We have a great team of behavioral economists here innovating and improving those features so that we focus you on the right things. We talk about whether you're on track or to your goals or not. And even if the market's down 40 or 50%, you can still be on track to your goals because we've invested you in an appropriate way, given the time horizon of your goals, given and maybe the right mix of stocks and bonds to reduce your risk and so on. That helps a lot, and it means that people don't really call us, but we have live people you can talk to 7 days a week. We've got CFPs, we've got financial experts on the phones who are willing to talk to customers whenever they need it. And so the truth is that people don't end up calling us, and part of that is because of the way that we position information in the site. Part of it's because when there is market news, we're pushing information out to customers, and we do that in a test and learn way. We understand how customers are reacting to that information and continue to improve it. And we'll talk about staying the course, or we'll talk about what happens. Can you predict when the market's at a top? Can you predict when the market's at a bottom? And the answer is generally no. And we also give things in the moment. So let's say you're thinking about changing your allocation. You're going to move everything to cash because you're scared about what the market's doing. We'll tell you before you make that trade what taxes you would pay. And when we show customers that information, we call this featured tax impact preview, 75% of customers decide not to go through with the transaction. And I find that really compelling because it means customers are not only saving on the taxes, which is great, but they're not market timing, which is even a bigger drag on returns.
Really cool. I like it a lot. We will have to take a look at, actually the market's down a little bit. Maybe I'll sneak into my Betterment account this afternoon and take a look. I try to stay away from this stuff as much as possible because I'm on my computer all day. It's all just way too easy to start logging into accounts and looking. But it's good to know that I think at least going forward, a lot of Betterment investors, I would imagine, are long-term investors. So they're not day trading. Is that correct? Like they're not in and out of their accounts on like a weekly basis, right?
Yeah, the vast majority of our customers are more set and forget style investors. They may be checking in, but they're not making changes.
Gotcha. So for people that are typically comfortable with investing in a basket allocation or maybe like a four fund allocation through a low cost provider of any sort, Vanguard or whoever, what additional assistance or benefits can Betterment give versus someone who's just kind of setting and forgetting it over the course of 5 years or longer?
Yeah, I mean, we do lots more than, say, Vanguard, or what you can do if you're even a very engaged Vanguard investor. For our customers, we save you a huge amount in taxes. So we do things to coordinate across your accounts, to tax loss harvest in your accounts that lead to really significant gains in returns. I mean, it pays for the fees that we charge several times over just in the tax savings that we get you alone. And we do things that you just can't do on your own. I mean, it's impossible to manage your accounts as actively or to monitor them as efficiently as we do it. We help you, avoid wash sales and rebalance with every transaction that comes in or out. And this is it's obvious stuff that everyone should have. And of course, no other firm provides all these services in the way that we do. And I think one of the hardest things is just kind of educating people about all this stuff, because there's so much, investing is such a sticky thing, and it's such a slow moving thing because it is complicated. And we're trying to make it simple. We're trying to make it really easy, but you still have to talk to people for a long time, and sometimes people have to hear about it multiple times before they get it and they understand all of these benefits. Beyond taxes, I think there's several other reasons that people come to Betterment. So there's, of course, the better returns through taxes. People use us because we are their central financial relationship. They like to see everything in one place, and so through our dashboard, I can manage my bank accounts, my credit cards. It's all there in one place, and so I'm getting advice about everything at once, and I see my total net worth in one view. I really like that. I used to use Mint.com, but now I use Betterment for that. People use us because we tell them how much to save and in what accounts. We'll tell you what you need for retirement. We'll tell you how much to put into your Roth, how much to put into your traditional, how much to put into your 401k. Do you need all of those or not? This is advice that everyone should have. And even if you think you know it, it's great to have our second opinion on it. and it helps you coordinate and balance those over time and tells you when you need to make changes and so on. That's really valuable advice.
I love it.
And it's something that other firms will give you.
John, thanks so much for coming on the show, sharing your experience with growing Betterment. Your personal story is very inspiring to any of us. I just want to wrap up with one final question. What advice do you have now that you wish you knew when you were 20 years ago when you started investing?
Oh, boy.
One thing. I'm sure there's a lot of takeaways, but I promise we'll keep you under 30 minutes. So.
I wish, if anything, that I'd gotten started on Betterment earlier because, there's so much still to do. And I just wish I'd started 10 years earlier down this path.
Well, we're all rooting for Betterment and we're all appreciative of the service and your inspiring story. So just want to thank you again. And listeners, we'll answer any questions you have in the group. John, thanks again and have a great day in NYC.
Thanks, Sam. Great talking with you.
Wow. I'm so excited that we were able to get Jon Stein on the episode for that long. I've seen some of his interviews, and normally, most shows, even like NBC, they have him on for like 5 or 8 minutes. We were able to get him on for an entire half an hour and really have him, dive deep into the story and why he started Betterment, as well as answer some questions. So, Sam, that was an awesome interview.
Yeah, and big thanks to John for coming on. I mean, this guy is so busy. He's in New York, running one of the hottest fintech companies in the entire world. So really appreciate him taking the time, coming on and sharing the story. And man, I got a really warm feeling about Betterment and the reasons behind it. And hearing John's story, just it's inspiring just to hear these entrepreneurs that went after something and are clearly making a difference.
And I think when you really listen to someone for half an hour and you get to know them, you can kind of get a feel, way more than just dollars and cents, just like percentages and fees and things like that. This is a company that you want to invest in. So, you have invested your own money now in Betterment, correct?
Yeah, just recently, actually. I just pulling up the account. So when we had Faber on way back when, or maybe it wasn't too long ago, somewhere, what was it, episode 15 or something, we all love Meb. Great episode, super smart guy. And we came away thinking, like, how can we invest alongside of Meb? How can we invest in some of these portfolio allocations that he's managing? And they didn't have a really easy way to do that. So they did a deal with Betterment that essentially Meb's company, Cambria Investments, is doing an automated robo-advisory fund through a portfolio through Betterment. And so I got an email about a week ago from Cambria Investments, and I'm like, this is awesome, right? Like, it's slightly different than, I think, a typical Betterment portfolio because it also invests in an ETF that is managed by Cambria. So I'm pretty excited about this. Like, first off, I'm excited to invest in Betterment and to be part of something, to have invested in something with a guy like that John has built, because I'm just, I think what they've put together there is awesome. It's really exciting to hear the growth in Robo-Advisory over the last 5 years. Like, I didn't even know that Robo-Advisories existed back in 2010. And that's, I guess, when, Betterment was really emerging. And now we are sitting here coming close to 2017. We're just getting our heads around it. But my account, so I put in money. And I'm actually pretty pleased because the market is down from when I invested. The market was at 18.5 it was at its peak when I put money in, of course. And the market's now at about, or let's say the Dow Jones is now at 18.3, and my account's up a little bit. So I'm happy to see that. And, we're going to track this. This is all these things that we're going to track and compare against other things that we're investing in and be able to share the details, the good, the bad, and the ugly.
Yeah, that's super cool that, you put your money into that. If you guys want to listen to the episode, it was episode 15 with Faber on building the all seasons portfolio, which is the, the kind of the master all catch all that Tony Robbins talked about in Money Master the Game. So as far as robo investors are concerned, Betterment is one of the largest companies that, and I think Wealthfront are competing for number 1 and 2. So there's tons of pros and cons for both, but even before we get there, let's kind of just talk about how if you either basically if you invest in stocks individually, it's guaranteed that you're either going to have a much higher success rate or much lower success rate. It's almost kind of like one of those things where individual stocks can be super high risk or super high, with high reward, or just super risky. With all robo investments, whether you choose Betterment or a different company, it's always going to be one of those things where it's going to be more kind of automated, but also kind of I think it's safer, and I honestly think that Betterment's biggest goal is for people not to lose money. And the only, even slightly negative thing I've ever heard about Betterment are two things, or robo-advisors in general. So one is you can potentially not make as much money as you would have if you had invested directly into the stock market. And one of the reasons for that is a lot of times they lean very heavily on things like bonds. So, there's no way, even if you put yourself in the highest risk bracket during the survey, they're going to force you to buy some bonds. And I think the reason why they do that is because if the stock market, has a big downturn in the future, they don't want their clients, losing a ton of money because it looks bad for business. I'm sure the news outlets, Fox News, CNBC, they're all going to jump on it, even though it wouldn't be their fault, it'd just be the stock market going down. But they don't want people kind of jumping ship and abandoning a ship if that happens. And that's why they force you to buy bonds, even though, you claim yourself as the highest risk profile.
Yeah, I think also, they are, in a sense, okay, it's algorithms, but they as a company are advisors, right? You can pick up the phone, you can talk to them. And I just don't think there's that many advisors out there that would ever say, okay, I'm going to take your money and I'll invest it, and we're going to go 100% stocks. You might find a few, but I think that's not just true with Robo-Advisory. I think you would find that with almost any financial advisor in the world. They would always want to put at least a percentage of your money in fixed income and or bonds, etc. And I also agree with everything you said about, it's in a lot of cases, for a lot of people, it's better not to lose money than to make a lot of money.
Yeah. So I think, Betterment and robo-advisors in general are going to be good for people who, want to save up for the future, while having growth, but kind of limiting the amount of money that they can kind of potentially lose. I think that, that's a great service. I would say for people who want to just they want to be more risky. I would say for those people using a robo-advisor is probably not the best thing in the world. The other thing that that I've heard is a potential downside is, even though the fees itself are very low for robo-advisors, especially with Betterment, that there is a cost of making that transactional fee. So every time let's say they rebalance your portfolio, or add in things like tax loss harvesting, that you're not actually seeing that trade fee. That's something that I want to dive a little bit deeper into, because I actually don't know too much about that. I don't know if obviously they're doing that for a reason, because they want to try to grow your portfolio, but I wonder, if a lot of people aren't thinking about that fee, as in, versus if let's say you had just bought 100 shares of Vanguard and just left it.
Yeah, I don't know that there is a fee. At least I would be surprised if there was a fee. I thought their only fee was the 0.15. Well, I think Betterment's 0.15, Wealthfront's 0.25. That was their only take. I don't think there's actually a fee on all the transactions in between for tax loss harvesting and stuff. But yeah, we should definitely do a deep dive and see if we uncover anything.
Yeah, I mean, there's definitely not a fee on Betterment's part. I was thinking more, is there a fee for them buying that stock on your behalf, or that fund on your behalf?
No, there shouldn't be. Not because a lot of these funds are just like going through Vanguard or something very similar, right?
That's definitely true. And I think the other thing we can look at is, the funds that they're buying, are there fees in those? So like, let's say they're buying as Vanguard funds. I know for example, VTI has a very low like cost basis at the end of the year. I think it's like 0.015 or something. But I know that for the other funds, I don't know what those fees are, and I'm assuming you're paying for that in some way.
Yeah, so we can just take a look. What we can do is we can do a deep dive into my portfolio on Betterment. It actually, there's a lot more funds than in a typical Wealthfront one. That might be because it's going through Cambria, but let's see, it's 1, 2, 3, 4, 5, 6, 7, 8, 10, 14 different funds. And it looks like the average fees of the funds per year are around, I'm going to say like 30 to 40%, which isn't astronomical, but it's also not, 0.05 like you get in some cases Admiral shares through Vanguard. So let's see, total. About 40% average fees. I just saw at the bottom. So there's some cost, and then you add on Betterment's fee. So that's basically a total of 0.55. It certainly beats the heck out of a financial advisor that's going to charge you 1% and then throw you in a bunch of mutual funds that are another 1.5%. So it's night and day compared to doing it that way. I also agree with you. If you want to be super risky, go straight stocks. And you can also do both, right? You can have a Betterment fund, and you can have, a Vanguard portfolio, and you can also have an E-Trade account or any type of stock account where you just go out and pick a few funds that are really aggressive, or pick individual stocks like I do and continuously get hammered on them. But I like having fun with it, and I like betting on companies.
So one big benefit of robo-advisors is the fact that they will auto withdraw, whatever you set it to. So let's say you want to set $3,000 a month, it'll just automatically invest that every single month. One of the big downsides of Vanguard, which I hope they change, is I'm not able to just automatically buy $3,000 worth of VTI every single month on the same day of the month. I have to manually log in. And the problem with that is, even though I'm very, unemotional when it comes to buying it, it's still, me clicking a couple buttons and basically taking out my wallet. And I think people can get really emotional when either the price is a little bit high that month, and you're like, maybe I'll skip it, maybe I won't buy it this month, or if it's like really low that month, and and you start getting crazy with it.
Yeah, I totally agree with that. In with Vanguard, so you bought VTI, which is an ETF, right?
Yes, correct.
So if you buy the funds instead of the ETF, you'd have to do a dive into the fees and see if it's a wash or not. Then it can automatically pull from your bank on a certain day. But for some reason with the ETFs, you have to do that extra click. Because in my Vanguard account, I have maybe 3 or 4 ETFs. And if I want to load those up, I have to go in and do them manually, like you said. But if you buy the funds, it can automatically pull from your account. But it's true about what you said, the emotions. And it still messes with me because I almost never let my automatic investments kick in. Instead, I see a dip in the market and I'm like, okay, I'll go put money in now. Or at the end of the month when my money's supposed to go, and if the market's at its high, I'm like, I think I'll just cancel this order for this month, right? So it's too touchy-feely still. And I've gotten a lot of joy, I would say, out of these robo-advisories because it's not easy to manipulate your portfolio much. There's less of a sensation to actually go in and play with things, right? It is there. You can change it a little bit. But because you can't manually select which funds you want to add more to, it just takes a little, like Vanguard, it's fun and easy to go in and play with it. And that's not what you're supposed to do, right? Every single person out there basically says passive is better than active. So I'm really bullish on these things, at least for me personally, because I know how touchy-feely I am and how I'm in front of the computer way too much a day. And, in turbulent markets, I'm definitely in my portfolios looking at them and thinking of making changes. So these are good for me. I'm very happy with them to date. And I think the big thing is going to come at the end of the year when we actually take a look at our individual accounts versus our robo-advisory accounts, or say our Vanguard accounts versus our robo-advisory accounts, and see how they performed.
Yeah, definitely. And I think another big part of it is, so the other, potential negative that I've heard, or was a bit of a controversy, is when there was a Brexit and everybody, Brexit, yeah, and there was and the stock market dropped because of it. There's a bit of a panic. CNBC had Jon Stein go on their show, and they basically barraged him. I think it was like 8-1 or something. There was 8 people versus him, saying that Betterment shut down trading for I think a few hours or like a window during that time, and why did they do that? And from Jon's point of view, or Betterment's point of view, it was because they wanted to protect their clients. I mean, I think from a company point of view, they don't want their clients losing money because it looks bad on them. And they know that people get emotional when the stock market drops. And people are going to be tempted to sell. And even though it'll most likely recover again, as history does, if people exit and they lose money, it kind of gives the company a bad reputation. And I think CNBC's point was, it was saying, well, even though you might have good intentions, is that your job to kind of big brother people and not let them make potentially bad decisions? And even on, I guess, even a bigger flip is, what if people wanted to buy more during that time? Right.
Yeah, it's a very tough situation, and you can look at it from both sides. And ultimately, with the markets recovering, a lot of people are going to be thanking Betterment for basically coaching them and not allowing them to get out. And I've saw so many people, including my parents, my grandma, and the little money that I had in the market in 2008 get totally wiped out. That one of this, we talked about this on the show as well, is I wish someone had been strong with my parents, grandparents, and myself, and potentially locked us out of the account. Now, of course, if that happened during the time, you'd be screaming, kicking, cursing, and everything else. But when you look at the damage that was done because of people's emotions, unsophisticated investors' emotions, not listening to their advisors and selling at the bottom. I mean, the damage is massive. It's retirement versus non-retirement, potentially for 20 or 25 years for my parents and my grandma and everything. So there is some element of being a real advisor in those situations and coaching people through tough times.
Yeah, I think a great idea would be, so during good times or when you sign up, there should almost be a checkbox saying, and where you're not emotional, things aren't going, crazy. Yeah. And have basically be able to opt in or opt out of a service where you can basically they can word something like in case of a downturn, do you want us to kind of protect your money and not sell it?
How am I feeling? Yeah, that's great.
Yeah, and I would check that, because I would say especially if it was worded and set up in a way where it says only sell if I don't lose money. So like click a box where saying do not let me lose money. And I think a lot of people, when they're logical and they're not being emotional, they will click that box saying that makes absolutely sense. Don't let me ever sell and lose money. Only maybe you can even allow the trade or to go into queue and say, okay, I'm panicking, or I need to buy a house, or I need to buy something. Let me queue up my trades to be able to sell so I can get some cash. But I don't necessarily need to do it in this 30-minute window when it might be super low and everyone's panicking. Let me just queue it up so it'll sell when I'm at a break-even point, or maybe even at another point where you make a little bit of money from it.
Yeah, this business, and I think robo-advisories as a whole, is so ripe for a good integration with artificial intelligence. To be able to really understand people's moods. So like if you take a couple of variables, let's say like a bad market, the market's down 5% or 10%, and someone's logging in, because you'd be able to track when people are logging in. If someone's logging in on average once a month to their account, and then all of a sudden the market's down 10% and they've logged in 5 times in a day, with enough data, you should be able to say, okay, this is an emotional investor. Maybe we should give them a call, right? Or maybe we should present some type of statistics on their dashboard that would give them some reassurance about when the market could recover. So how many times in the history of the stock market has the market been down 10% and then recovered 30, within 30 days later? And that type of data, I think, would be so valuable to show. If the market's down 10%, you log in, hi customer, the market's experiencing a bit of a correction. This has happened 462 times over the last 50 years, and on average the recovery time is 45 days or something. Something like that just gives people a little bit of a statistical view, so they don't go in and think the world's coming to an end and make a bad decision.
Yeah, absolutely. And I really believe that just educating people about that, giving them options, is going to be great. If anything, if they really wanted to allow people to do whatever they want, want, even though it's a bad mistake. What they could do is they can have like 4 different like continue buttons where they pop up and they just kind of educate you through like, are you really sure you want to do this? Here's some information. Are you really sure this is what's going to happen? Are you really sure this was going to happen? And I might just piss off, that might piss off some people. They might just kind of go through it without actually reading or watching the video. And I think that most people, when they are emotional and they're panicking, they probably will just get annoyed and they probably will just skip through it and not think logically. It's so hard to convince someone. I mean, if anyone who's ever had a fight with a girlfriend or a wife when they're being emotional, it's really hard to talk any logic into someone, even if you're right, when they're mad.
Yeah, absolutely. And it also depends a lot on the investment experience of that investor. I'm still emotional today, and I've been when it comes to investment, well, in general, but when it comes to investment decisions, I still am, and I've been investing now for 12 years. But for sure, when I was in college and I had made my first few $1,000s and I put it in the market, and I logged in 2008, and my account was down like 40%. And I literally thought the world was coming to an end. And that now, that happens, and that type of loss can happen to us in a day. And we're much more tolerant to this type of thing, so we've been through it. But so many people now, the millennials coming out, they're going to start investing through platforms like Betterment and Wealthfront and other robo-advisories, and that's going to be their first type of investment. And when they log in and they see that 5 or 10% correction, they're going to need a lot of hand-holding.
Yeah, so I definitely agree. And I think, what I kind of want to wrap it up with is, who is Betterment's service great for? There's going to be pros and cons for everything. And, that's kind of the whole point of this podcast, is to explore different alternatives from people. But I would say definitely for sure, Betterment would be good for people who, are more concerned about, not losing money or not forgetting to invest, and having a very, I would say, like a very upward trend with their money in general. I mean, obviously, there's going to be a lot of factors, but, they're not looking for the biggest risk, biggest reward. They don't really trust themselves emotionally. They'd rather have it be automated, where they don't have to log in every single month and click the buttons to buy. People that want to be able to set it and forget it, I think Betterment's great for them. And what makes Betterment better than Wealthfront and the other robo-advisors is for people who either have $100,000 or more to, no, sorry, was it 10,000 or 100,000? I think it's $100,000 right now. Or if you think that you're going to eventually have $100,000 or more in the next year or two, because their fees significantly get lower once you get to that 6-figure mark.
Yeah, I agree totally. And I'll just echo echo what you said about who's a good customer for a robo-advisory. I think anyone who's got at least a 6 or 7 year investment window, which would be mid to long term, especially for people long term, and they're content with trying to optimize around getting 8% returns. You're not going to get filthy rich off these things, but I think it's a good piece of anyone's overall investment portfolio for the long term.
Yeah, definitely. Because I think, trying to get that extra 2%, trying to go above 8%, you also bring yourself into more risk. And, risk not just in terms of the investment itself, but also risk that you will get emotional, you'll forget about it, you'll miss a few months or 6 months or a year of investing because you just, either because the market is different or because you just kind of forget to log in. So I really like robo investors for that feature. Even for me, even though I'm very good at logging in every month and buying shares of index funds, like even then I mess up, and this is something I'm thinking about all the time. So if you're just a normal person that you're not thinking about this 24/7, I really think robo investors, even though there are a smaller chance of getting super rich from it, is way better than not doing anything or having the chance of messing up.
Good advice and good way to wrap up the episode. So everybody, hope you enjoyed that episode with Jon Stein. We certainly did, and we have lots of great episodes coming up for the month of October and November already lined up. So stay tuned, leave us your comments, your feedback, and we'll catch you guys in the Boss Lounge on Facebook.
Yeah, and also if you guys do want to sign up for a Betterment account, we'll have a link in our show notes, which will give us credit for referring you if you wanted to sign up. And that is it. So thank you guys so much for listening. Big thank you to Betterment and Jon Stein for coming on the show, and see you guys all next week. Thanks for listening to the Invest Like a Boss podcast. Join our mailing list at investlikeaboss.com to get exclusive access to our insider investment portfolios and our private members forum.
If you enjoyed this episode, please subscribe on iTunes or your favorite podcast app. Tell your friends and leave us a review in the iTunes store. It helps more than you know. See you guys next week.